today's topic is modernizing the governance, risk compliance, cyber audit, handful, and to enable resilience. So I guess there are two buzzwords here. One is modernization and the resilience, right? And the question is, well, it is what it is today. What's the future? What's tomorrow? Right. So let's take a wild guess.
Right.
You're not getting taped. You're not getting recorded. Everything stays here in Miami. Let's talk about the future of risk. Right?
Yeah. We just want to jump right in.
So please introduce yourself.
Yeah.
Right. And then it will be a conversation. So
Sounds good. Yeah. So I'm Brian Prickey. I'm the Chief Information Security Officer for City National Bank of Florida. I got a chance to talk about ChatGPT earlier, and my joke was I lived like the building right there, so I was able to walk back and forth all day today. So it's been great. Nice. It's been fantastic. But prior Marines, federal government service, and then mostly financial services, all overseeing technology GRC. That's been really the primary focus in the context of the strategic, operational, reputational, and compliance risk for the financial institution. So as you can imagine, there's many, like any org, there's many layers of that. So that's my background.
Thank you.
Good afternoon, everybody. I'm Eileen Fahey, the Chief Risk Officer of Fitch Group, mostly a credit rating agency. I work for as a credit analyst. Most of my focus is working with credit, but in the past 5 years, I've spent a lot of time on how we have built out a full risk audit criteria review and approval, which is a
Welcome. Thank you.
I'm Marcelo Cruz. I'm a managing partner for Yakami Advisors. I've been working in risk for a really long time. So I worked for Lehman Brothers. I worked for Morgan Stanley. I was a CRO for a number of other large firms as well. And I set up this shop, which is a consulting shop, but also a private equity. So we invest and also consult for fintechs and emerging financial companies, right? So, but that's my background in short, so we can move to the discussion.
Yeah. So first off, let's actually define what resilience means in today's world and in tomorrow's world. So Marcelo, if you want to start.
Sure, yeah, let me give you just a background. So as I work with these mid-sized companies and big companies, some of these companies are pretty big, are working in sectors like mortgage, auto, student loans, things that you say, well, I got my student loans from Wells Fargo, from other company, but most of the time they don't service those. So they send to these smaller companies that I consult for, work for them. So a company with 5,000, 10,000, they process. They are lenders, but they process this, they service these loans, this is the vocabulary. So, and banks, especially for mortgages, that become more frequent in 2008 after the crisis, right? So they said, we don't want to handle foreclosure anymore. It's terrible for a big bank to say, we are kicking out poor people from their houses, our family from their house. So they leave to the small firm to do the job for them. So they do this job of foreclosing, for doing this, all this stuff. But these companies, they're not regulated for the Fed and OCC, right? It's much worse. So they're regulated for the 50 states, the CFPB, and in the case of mortgage, they are regulated also by Fannie Mae, Freddie Mac, etc., which they sell these loans to, right? So they are extremely regulated. Regulators sometimes are different from one. Fannie Mae say one thing, the other company say another thing, and worse because they work for Chase and JP Morgan. They also sometimes have the visit from JP Morgan and all these guys from the Fed as well to check it out what they're doing, right? So we never heard of these companies, and I'm not going to tell the names as well, but they're companies who actually process these loans for you, which is basically the most important things in your life. So your house, your car, your student loans if you went to college, and depending on that. And there was a concern recently. There was a discussion on the Financial Stability Forum, which is a forum in DC with the several regulators, the OCC, the Fed, and others, the Department of Treasury, of this shadow banking, the non-banks that are not regulated directly, but they can cause tremendous headache for the economy, right? Because they're getting bigger, because banks don't want to be associated with this, the issue. They lend you, but they're not. So the resilience of these companies are worrying because they don't get the best talent. They don't get, everybody wants to work for Goldman, for the Morgan, for et cetera, but they don't want to work for these companies that are based in God knows where, and they're not the best talent, right? So, and one concern talking about resilience of this mid-size, but actually they do most of the work, the pipelines or escrow, the servicing. You pay for this guy, the insurance company, they pay insurance, home insurance for on the behalf of the borrower. So the fact that they're not, they don't have the top talent, they don't have ways to measure this risk, it is an issue. They operate like banks operate 20 years ago, right? So today. So I'm not judging if you say I work from one of these companies and they're very good, so I trust you. But most of them that I work for and I consult for them, they don't, right? So they need more resilience, they need more GRC, they need more compliance. In compliance, because I mentioned these 50-something companies they work for, right? And I started to extend myself a little bit. But these regulations change, these standards change every month, and you need to have a clear tracking that what is going on, right? So if one home that you landed, they have a fire alarm that is old, more than 5 years, they go to Fannie Mae and say, oh, we're not gonna buy that loan, and the company will have to bear the loss, right? And from risk perspective as well, so they take huge amount of risk for reasonable reward, but of course they take a large amount of risk. And if they go under, right, so they probably gonna be a tremendous problem, then everybody gonna know them, and that's what they are. So sorry, I overextended myself a little bit.
No, it's okay. It's a good story. I think as you look at the GRC, cyber, and audit, right? I look at those as a financial services as your second line, GRC typically, right? Your first line, cyber, and then your audit, your third line. And I feel like all of those entities and all of those functions and processes have to work together to make sure you're enabling or your ability to return to normal operations, whatever that means. It could be technology, it could be business processes and the services you provide to your clients. Typically, that's what you're trying to do. So the question about what is resilience, I think it really is framed around your ability to return back to normal operations. Just if I kind of, just again, looking at the topic there, I don't know if you...
I would agree with that. I would just add, I think it's a time frame.
Yeah.
So is it a short-term or a long-term resilience? So for Fitch, the long-term, and for what the firms Marcelo was talking about, the long-term is reputation.
Yeah.
And how long can you sustain your business and your product, and how do you innovate that product over time versus the short time being able to respond to crises, whether it's a pandemic or a hurricane or a loss of technology.
Strategic risks.
Yes.
Yeah.
Yeah.
So one of the risks mentioned, for example, Asia or China, decoupling, right? So financial firms and most important, not financial firm manufacturing, leaving China for other companies in other countries in Asia, it'll be cheap enough for them as well, which is a very risky process. How fast can they do that? And clearly they're showing this not fast at all, like chips, for example.
But knowing you have that concentration risk is important so that you can
Correct.
be resilient. I think resilience is kind of the response to that if the bad thing does happen. But that's definitely a strategic consideration for sure.
So this panel everybody doesn't need to agree with each other. We just want to throw some controversies here.
Different points of view. You know? Yeah, all good.
So does it mean that resilience mean that it is after the fact, or is something which has to be done proactively?
I would say proactively.
Proactively.
You can't, if you let it, so there, again, short term and long term, proactively helps you prepare for various crises or disruptions or processes, and what alternatives can you put into place fairly quickly. So it's not like we're never going to be disrupted, but how quickly can we respond to that?
I think it's the risk event that you're describing. So proactively planning for it, certainly. But I feel like when the risk event occurs, how resilient are you to the impact of that to your business? That seems to be kind of what we're all trying to make sure we have is plans to react to those changes in the environment, changes to our, again, in the context of cyber, it's often a cyber attack or some technological disruption.
So that's post rather than...
Right. So when that risk event occurs, then we have to, how quickly can we respond and execute our plan? The plans often go out the window. We all know that, right? But it's the dynamism of your teams and of your plans and of your technologies to come together, and the resilience of all of that, right?
I work for, I'm on the board of risk.net, which is a very large risk publication, right? And we do every year the top 10 risks, top 10, and then we put in the pocket top 20, right? And pandemic wasn't even the top 20 in 2020 in the beginning. January, we published in January. People concerned cyber number one, cyber number two, cyber this number three, four, five, six. Then pandemic happened, right? So that's why I agree with what she was saying in terms of regarding if you don't plan, right? So that something might happen down the road. You're also going to be concerned with something more obvious, which is the cyber. People trying to hack me thousands of times every day from all the parts of the world. It's thinking about this stuff that might not happen, but there's some strategic concern into that as well.
So when you say plan, is it like if you look at the normal distribution, are we talking about the fat tails or are we talking about the mean or the median? So typically the plan is within that range, but when the pandemic fat tail thing happens, how do you prepare for those kind of events?
I was going to say, aren't your operations usually addressing the mean and the median? So the plans should be more of the fat tails, what's going to happen. So I'll give you an example. We had a very recent example where our disaster recovery they do rotating tests on a quarterly basis. Well, they wanted to run this test over a number of weeks when the U.S. sovereign rating was subject to question and heavy debate in the markets. And I thought, no, you can't run those tests then because we could potentially have difficulty putting out press releases and research during that period because if there's something happens that would be totally unexpected in the DR testing, it may impede our ability to quickly comment and put out those press releases. So that was an in advance decision of, well, let's push the test a little bit back or move it forward because we don't want those time periods to overlap. So that's a small example, but on the fat tails are the hardest ones where, to Brian's point, they may occur and you might have a plan that you've tested, but as soon as it starts to happen, nobody's looking up for the plan and what was written down. They're just starting to react.
Yeah, VAR is the fat tail, right? When you do risk for us is always a fat tail. So the regulatory demand for VAR, it's 99%. So it is per definition the tail. So if it's something in the middle, like a normal distribution, you expect this is expected. Oh, people might not come to work, or 10% of my employees not coming to work. It's upsetting, but that's kind of expected. We don't expect no one comes to work because of pandemic or because our offices are closed because there was a terrorist attack, right, or something like that. We discussed in our preparation for this meeting the Lehman Brothers situation, right? So the 9/11 attack.
Yep.
That we didn't have a business continuity plan at the time at Lehman, and basically people were working at Hilton Hotel, Midtown Manhattan. And most people that work in my department didn't know, do I have a work? Because we didn't have phones to call people, right? So landlines to call people, say, no, we need to come to work at Hilton or there's no remote. There was no back office, like back systems in New Jersey or other places. So now we do. So because that happened, 9/11, everybody has a parallel system, a cloud that will be a backup, etc. in some other places. But we can have the argument that all this stuff happens once and then we become really prepared. It's for the stuff that we're not prepared, the tail, that's the issue that we're not even thinking about.
And that's part of the great skills, the skill set we need as risk professionals, right? You have to be able to think many steps ahead, to imagine within that fog of war what could potentially disrupt my organization and create those. You're never going to avoid and prevent every risk event, but thinking through what those impacts could be and having those plans and talking about it, having trainings and tabletops and all that sounds like ethereal sometimes, but those are important meetings to hold so people do know their roles and they do know what resources they have. When you think about, can I connect remotely? All of a sudden now 10,000 people have to connect remotely for several years in a row, right? Imagine how many technology teams were freaking out because they're used to, they track how many people are connecting over time and throughout. So now they have to go and buy new equipment. Oh, everybody's buying that same equipment, right? So again, who is thinking through these things all the time? Typically, it's the risk professionals who are worried. It plagues us all, even when we're lying in bed, right? I'm sure that we all think this through, right? Will my building elevator go out? Just always thinking. You got to make sure you're not worrying all the time and you're risk assessing. That those are very different things. So.
Right. So you talked about VAR models. In 1990s, the market risk quantification became very popular. Credit risk was almost catching up. Operational risk in 2000 few years in there, it did catch up. What about the other kinds of risk? Are we really going to quantify them, or are it still going to be a qualitative risk assessment? I would start with cyber.
Well, in the cyber side, quantifying the risk, it's scenario by scenario. So you look at key critical business processes, you're looking at your crown jewels, you're looking at, what is making my business money, right? You really focus on those, and you do want, there's, the FAIR model, and there's other formulations depending on how mature you are in your organization, how much data you have about the activities that are happening, the valuations of those activities. All of those have to be defined, and as a risk professional, you can lead those conversations and help suss that out of the various lines of business and the different professionals, but you rely on their knowledge and expertise to do that. So in absence of that, you do have to have more of a qualitative view of the risks, and I think it's you'll see that stratification as you move from qualitative to quantitative, right? And you start putting harder numbers to those things. You can now look at investments and return on investments for those resilience plans. And I think that just speaks to the maturity and size and complexity of organizations will kind of dictate, what you're able to do and not do. And then if you're just the one guy in the basement trying to come up with a risk plan, right? There's still methods you can use to be maybe not as effective as the one who has a whole team of risk professionals and fantastic tool sets at their disposal. But on that scale, there's always something you can be trying to do.
I think one of the challenges that we have right now is data itself and the challenges of data privacy, the various views on data privacy that are across the globe, and then governments like China, which are taking an extreme view. So we had certain countries that were starting to require, and some are still looking at data residency, which really challenge a global business and can increase our costs dramatically if data residency becomes required. But then it will also challenge, you get extremes, as I started to mention China, about not allowing data and starting to clamp down on data that can't be allowed out of their country. So what does that do to your investment in China or your view of China or a rating agency's ability to quantify its credit risk and any of the businesses in China that we already have credit ratings outstanding on? I mean, we have offices in China. We have both a national and an international office there. And we're struggling right now with, what do you do with that and how do you plan for the changes going forward? So as Brian said, you can't plan for everything, but you have to be flexible and think about things in different ways.
Nice.
Yeah.
So
we're going to disagree now because I think we can quantify everything. It's just the time that sometimes it takes longer to get to a methodology that'll be proper.
Like, is it worth it?
Exactly. Operational risk, for example, I spent the beginning of my career, I'm old, so I got the beginning of the operational risk. Operational risk, the debate for 5 years was, can we quantify it or not? You can see articles. If you Google that, you're going to see articles for many years, people questioning that, and becomes undoubtable that we can, not just can, because it's on Basel II in 2004, right? But until 2002 and 2001, people would debate, large debates that cannot quantify. It's just more difficult, and you need to, but there are methods to do pretty much everything, right? Even as Brian mentioned, scenario analysis. So I don't have a lot of data. You can do scenario analysis, looking at your revenue.
Comparative.
Comparative. So my revenue is $1 billion. So if there's this scenario, how much would I lose? You sit down with people, you quantify something. Then you move to something more. Then I start having some losses, right? We start qualifying. With the cyber, for example, there are a lot of initiatives, some from the Fed, some from the banks as well, into quantifying. We're not there yet. There are many hurdles to quantify. It doesn't mean that it's not going to be quantifiable. In a few years, this debate is going to die, in my view, and there will be a methodology to quantify that. That will be accepted by everyone, hopefully. But there's always this question, oh, this is difficult, low, medium, high, that's enough. It's never enough. You cannot manage something that you cannot quantify.
It just depends on how important is it to the organization to quantify that. And if you don't have the executive impetus or leadership to say it is important to make sure we understand truly how much this would cost us.
Yeah.
Right? And that's that leadership, that top down, that tone from the top is really critical to have any sort of a functioning risk program. I learned that because I used to report to a chief risk officer. So.
Yeah.
So Marcelo,
Go ahead.
though, one of the questions, if you can't quantify in terms of human risk and turnover, is your view that can be quantified?
It's a
in
way to
a
model that. So if
operational?
you model that way, like the cause, what causes the risk, like human or computer, etc., becomes very difficult because you then got to identify what caused the error, right? But you understand we have some losses and what caused the loss. Instead of what caused the losses were due to the cyber theft or due to that. So, but was human cause? Yeah. What caused? For the time being, the source we don't care at the moment. It's just the impact. If down the road, if you can do like a sourcing, I would probably not go to the cause because one event might have multiple causes. Might be human, might be the computer or the issue, or the system was the issue, etc.
When you do your root cause analysis of a risk event that occurred, though, you'll look at are these administrative controls, technical controls, where they need to be based on the source, and will it actually help reduce the risk or not?
Exactly.
From a control design perspective.
From a control design perspective, from KRIs that will monitor your controls on a timely basis, etc. This is how you start quantifying something. But if you don't have any data, like when online banks started, right? So banks were, but we don't have online banking until today. Now we don't have losses yet. But let's try to figure out how loss is going to happen. We sat down in office in 2011, Morgan Stanley tried to think, what scenarios can happen? We went through a lot of stuff, and then the loss would be maximum this one, to avoid this low, medium, high. So we have some numbers, right, to impress people. And just for example, this research that we do, this poll that we do across all over, everybody responds to this, just executive, not people can go and respond that. The number 2 risk concern right now in the US is regulatory risk.
Yeah.
If you measure that, we don't have enough file because they fined me $10 million because we were sending stuff on WhatsApp. And I said, okay. And what's the number 3? Cyber. You know how much money we lose in cyber, how much we invest in cyber, but the perception can be wrong. That's what I'm saying. Human perception of something can be. So thousands of risk managers in the US said number 2 is regulatory because they're being annoyed by regulators right now, right? They're being very intensive. That's the order from Washington. Yeah. So that's the point. So, but it's not the largest risk. If you look at from the CEO perspective, would I lose $3 billion tomorrow of regulation? No. There'll be a large negotiation with the OCC and the Fed, the SPB, on how much they're going to fine, like Wells Fargo type or others.
They're reasonable.
They're going to be reasonable. Cyber, they're not going to be unreasonable. They'll be a surprise on day gone.
That's there's negligence, and I think, I keep looking at that panel discussion topic and your GRC function. Do you have the right policies and the right standards and the procedures documented? Have you at least tried to do an appropriate level of risk management within the vein of that? Are you ingesting and understanding the regulatory change landscape, right? Your technology risks are very specific and nuanced. They're not as generic as maybe other line of business risk types. And then your audit function, is it functioning correctly where they're identifying issues and identifying control failures, and are all of those apparatus working together to articulate where are your control gaps, right? And that, I think all of that, just trying to again relook at that discussion topic, I think all of those inputs should help you build out a more a mature functioning resilience plan, but they all do work in concert, or they ought to.
But they work in concert, but in many times I don't know your organization, but siloed organizations, right?
Course,
so yeah. And so we're trying to unify that one organization that don't even talk to each other right now very well.
They don't. You're saying they don't.
The siloed organization, they don't. So the business will be isolated and many times combating risk and compliance and audit.
But if they all used a common platform, I think we could agree.
And the taxonomy.
You would have common taxonomies and a common system of record. You could have that level of visibility.
Taxonomy.
Yeah. Do you find the first line managers accept their risk and feel like they're accountable? There was an earlier panel that talked about accountability.
To empower a risk owner who doesn't even know they own risk, right? Takes training, and you have to educate them and have those sessions. And I'm on the control side a lot. I do the technology risk GRC piece, but I tell them, you are a control owner. And they're like, what is that, right?
Yeah.
Like, okay, you're a system administrator. You're setting configurations, and you're allowing people to do things in your platform. You own that control, and these are the list of the control objectives from the standards. And it's a whole educational thing. If you don't do that on a regular basis, they don't know what you're talking about. So
Yeah.
training is key.
And I agree. I mean, from a point of view to defend the business unit, I mean, they have a concern which is bring revenue, right? So
Yeah.
that's not ours. Ours to make sure that they don't go below. So having a clear risk appetite, a dialogue that will say, up to here you can go. Don't talk to me. That
Yeah,
you're fine.
yeah.
But if you're gonna breach that,
Risk appetite.
for everything, not just for
yeah.
the VAR, for the market VAR or whatever you're talking. So it's for cyber. It's for
Next
anything.
time, tell them you're here to prevent the erosion of revenue. That's a key. That's always my retort when they say, "I'm too busy making the money."
Money,
Okay,
yeah.
we're here to help you prevent the
Pay your
losses.
salary too. So all that sort.
Yeah.
And that was siloing because they didn't get together and say, oh no, but these guys in risk, they don't really understand us, right? So how hard it is our job. And this will separate. If you don't have the someone taxonomy, the risk appetite, something that will empower them, you know what? If you stay within $100 million here, losses, we're good because the board say we're good, right? But if you're gonna go above that for some reason, you're gonna take other risks. We have to have a debate.
So in tomorrow's world, technology is moving so fast. We talk about artificial general intelligence. We talk about quantum computing. We talk about AR, VR technology coming in, right? It's already there today.
It's there.
So in the mixture of all of this, right, a GRC becomes a much wider topic, right? Because now you're going to come up with new types of risk. Apparently, with computing algorithm, we can break any password, which is today we think is encrypted. Yeah. So maybe it's available in a few years' time, right? So I will leave it at that, but I know we are up for time. So any questions from the audience? Sure, there must be one.
Covered it so well.
If not, I'll ask Prasad to ask a question.
Prasad, you ask a question. Yes, sir.
We worked together way back when.
Yep.
Value at risk for op risk, right? Value at risk for op risk and so on. Somehow I felt afterwards and being through the industry and working with op risk and on the lines of like credit and market and all that, right? Those risks. Somehow that value at risk concept never really came to fruition. The sophistication, I mean, I understand VAR has its own deficiencies with respect to black swan events and all. Somehow I felt that the same level of sophistication did not happen in operation risk. Any thoughts on that?
It depends on what you talk about. The models used in operational risk are way more sophisticated than the ones in market and credit. So you talk about normal curve, right? The Gaussian distribution. So that doesn't exist in operational risk. There are models that statistical distribution, they have no formula, no format, just a format. So it's just because operational risk is not going to have the same amount of data that market risk will have. And credit will have less data even, right, than market. So the model is always going to be less credible than when you have less data, as Brian pointed out, which is the case for most operational risk, but not all of them, right? So if you talk about execution risk in operational risk, we have enough data, thousands of data points every day. So the models are significantly comfortable, right? So from a statistical point of view. So that view is not necessary, but what I was trying to convey here is that even if you don't have data, the risk is new, or you're imagining a risk that doesn't even exist yet, you can play with some mathematical framework like scenario analysis or others that works, right? So during the Cold War, we didn't know how much weapons Russia has or vice versa. So the way we play was like a Delphi method that we're trying to get experts on one side. So how many nuclear weapons they have, right? So we didn't know, but we have an estimation based on different type of experts.
To come up with a reasonable methodology.
A reasonable methodology and
Start
number.
somewhere.
Exactly. To get somewhere. Not just one person, one military saying that, wow, they have much more than us, so you have to have more. Say, yeah, of course you're going to say that, right? So it's having different people giving different opinions. So we can have a construct that will be acceptable even if you don't have enough data. Data will drive how good the model is going to be.
Thank you so much for your time. I really appreciate your time here and the discussion.
Thank you.